Before we begin, a quick note. This briefing is generated for informational purposes and does not constitute financial advice. Welcome to today's briefing. We're cutting straight to the data to analyze Sportking India's Q3 and 9-month FY26 performance. Here is the bottom line up front. Sportking is currently maxed out on production capacity, hitting 33% profit growth and launching a 1,000 crore expansion to break their operational ceiling. This chart shows Q3 FY26 revenue reaching 646 crores, a 6% increase year over year. Profit after tax surged 33% to 25 crores. Expanding to the 9-month view, EBITDA reached 200 crores, driven by a 59 basis point margin improvement. Looking at the cost breakdown, raw material expenses rose significantly against the prior year. However, power costs remained virtually flat, providing critical relief to the bottom line. By holding fixed costs down while pushing high sales volume, Sportking absorbed the rising material expenses and protected margins without relying entirely on top-line price increases. The production metrics show a company running at its physical limit. Utilization sits at a red line 96%, with yarn production at 21.1 thousand metric tons, perfectly matching 21,000 metric tons in sales. Demand shifted outward. International exports overtook domestic business, accounting for 52% of total revenue. This map illustrates Sportking's global distribution footprint. They are now actively exporting their textiles to 39 different countries. The company is perfectly positioned to capture textile demand from the global China Plus One diversification strategy. The immediate problem is that they are physically out of product to sell. When a manufacturer is tapped at 96% utilization, organic revenue growth hits a hard wall. To increase output, physical expansion is required. To solve this, Sportking is executing a 1,000 crore greenfield expansion in Odisha. Over the next 12 to 15 months, they will add 1.5 lakh spindles, increasing their total spinning capacity by 40%. Simultaneously, they are executing a strategic merger with Marvel Dyers and Sobhagya Sales. This moves their operation from strictly spinning yarn directly into dyeing fabrics and manufacturing ready-made garments. Transitioning to finished goods pushes the company higher up the textile product chain. This restructures margins and bypasses the volume limitations of raw yarn. To summarize the current profile, Sportking is highly profitable, operationally maxed out, and actively capturing the macro shift in global export sourcing. The true test for investors over the next 4 to 6 quarters will be execution. Watch the deployment timeline on the Odisha expansion and the operational integration of the garment business. Thanks for watching. If you found this breakdown valuable, please share the briefing, drop a like, and subscribe for more efficiency-driven market analysis.